Hey, Bob.
Hello, Teddy. Welcome back.
Thank you. Hey, Bob, sorry to bring this up now, but do you prefer
Yeah,
Professor Smagula or?
you can call me Bob.
Okay, thank you.
Call me Bob.
Just wanted to make sure. I think Brenda, yeah, Brenda was kind of saying I should probably call you Professor Smagula.
Well, you can if you want, but no, Bob is fine.
All right,
Bob
thank you, Bob.
is fine. We're not. This isn't. No offense. This isn't Harvard, but it's. We're a little more informal. So Bob is good.
Okay.
All right, let's see. I guess we're up to chapter 7 now, huh?
Chapter 8, actually, I believe.
Chapter 8.
Let me double check.
Chapter 8, huh? Okay. Yeah, you're right. Chapter 8. Yep, I got that racked up here.
Perfect.
Okay. Well, we'll wait a minute or two, see if anybody joins us, huh?
Yeah.
So who do you like, the Astros or the Braves?
I want the Braves to win.
Me
Rather,
too.
yeah, the Astros have won too much.
Plus,
Or
they're
they-
cheaters. They were such cheaters.
yeah,
My God, banging a metal garbage can to indicate a pitch.
yeah,
That's about as blatant as you can get, huh?
I agree.
But it was surprising to see the Dodgers go out as easily as they did.
Yeah, I was really surprised about that too.
I'm still sick about the Giants though. They came so close to beating the Dodgers.
Yeah, it's going to be interesting to see if Buster Posey stays or not.
Oh, I would hope he does. I
I
mean,
would hope so too.
at his age and the stage in his career, he's built up his whole fortune in San Francisco. Hopefully, he's not going anywhere.
Yeah.
I didn't even know he was a free agent, huh?
I think yeah, I think his contract is coming up, but he said he just wants to win, so who
Well,
knows?
he won more than anybody else this past year.
Yeah.
Just not at the end of the season.
Yeah.
All right, let's see. So far, it's just the two of us, Teddy.
Yes.
No Brenda, huh? Okay.
That's weird. I could give her a text. Let's see.
Yeah, maybe just say, "Are you coming to class today?"
Okay, well.
In the meantime, let me look over the PowerPoints.
Okay, I just gave her a text.
Okay. All right. Let me share the screen. Share screen. Chapter 8 PowerPoints. Make them bigger. All right, Teddy, you and me. We'll get it done, okay?
Okay, sounds good.
I'm going to be talking about accounts receivable and notes receivable in this chapter. How companies recognize accounts receivable. So we got 4 different things to learning objectives. How companies recognize accounts receivable. Well, we should know by now that we record receivables as soon as we make the sale, right? It has nothing to do with the monies being exchanged.
Yes.
It doesn't follow the cash. So as soon as we ship our product, whammo, we debit accounts receivable and we credit sales, okay?
Okay.
And you could have different kinds of receivables, types of receivables. Amounts that customers owe us on account from the result of sales, that's of course accounts payable. Then you have notes payable, where we loaned money to somebody. That's a formal written promise to pay with interest. And then you can have other receivables, interest receivable, like we were working on earlier this morning, Teddy,
Hmm.
advances to employees. Where I worked for a long time, I would sometimes loan money to employees. an hourly guy would come to me, look, I'm short this week. I need $50 to get all my rent money together. Can you help me? And I would give him $50 and then take it out of his next paycheck. So that would be like an employee advance receivable.
Okay.
And I don't know why they're showing these percentage of receivables here. I'm not sure what the significance is. Service organizations record a receivable when you do the service. Merchandising, which is what we're doing now, record receivable at the point of sale. And we might offer a discount, huh? And the buyer might return things to us. So we're going to go into a little bit of a repetitive area here, but that's okay. Recognizing accounts receivable. Jordash sells something to Polo for $1,000. Terms are 210 net 30. Prepare the journal entry. So what would that journal entry be, Ted? What will we do, Teddy? What will we debit and credit? We just sold something.
Oh, we would have accounts receivable.
There you go.
And then if we sold it, inventory,
Yes.
sales revenue.
Yes. 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 It would be sales revenue, but yes. You would also debit cost of goods sold and credit merchandise inventory. They're just not showing you that part of the transaction here. Polo returns merchandise. Well, we never debit sales, right? Never. We're going to have to debit what account? Sales, returns, and allowances, and credit accounts receivable. Because this customer no longer owes us the $100, right?
Yes.
And now we get paid for the balance. And what was the balance? The balance would be $900, I suppose, huh?
I think so.
Wow, but look at this, Teddy. They took the discount, okay?
Okay.
We've talked about the discount 210 net 30 before, Teddy.
Yes, we have.
Okay, so this was a 2% 10 net 30. You get a 2% discount if you pay in 10 days. So, Teddy, let me just turn off the phone here. Hold on.
If you need to take it, feel free to as well.
Let me just see who this is real quick.
Yeah, of course.
Hello.
Hello, this is Amazon. This call is to authorize a payment of $1,500. We would like to inform you that there's an order placed for Apple MacBook Pro and iPhone 11.
Wow. What that's called a scam.
It is.
I didn't order anything. Okay. Take the wind out of my sails. So you understand where they got the $18, right? $2, 2% times 9.
Yes, I do.
18. Recognizing receivables. Some retailers issue their own credit cards. Like you could have a J.C. Penney card. They're the ones who really charge the big interest, though. So you sold something with a credit card. You debit cash, actually, not accounts receivable. Technically, it's receivables, but reality, it's cash, sales revenue. If you still owe the money, they're going to charge you 1.5% per month. Multiply that by 12 months. That's 18% a year. That's a ton of interest to have to pay, Teddy, isn't it? 18%.
Yes, it is.
If you took $1,000 today and put it in the bank, you wouldn't even get 1% on it. And here they're charging you 18%. Okay, we have a return here. Wilton sold merchandise to Bates. Bates returns something with a sales price of $2,000. Wilton receives payment for Bates from the balance due. So we sold something for $50,000, and then Wilton receives. Then Bates returns the merchandise, $2,000. So let's be good with that journal entry, Teddy, on a return of merchandise. You never debit sales. You debit sales, returns, and allowances, and you credit accounts receivable because the customer no longer orders this. And that looks like it leaves a balance of $48,000, right?
Yes.
But they paid it on time. So they get the 3% discount. It was 3%, 10, 15, 3%, 15, net 45. They paid within 15 days, they get 3%. So we're pretty good with that type of transaction, Teddy, with the sales discounts.
Yeah, I think we're good at it.
Okay. Valuation of receivables, net receivable. We talked a little bit about this earlier today. Net receivable, sales minus the allowance for doubtful accounts, huh?
Yeah.
So let's see what we have here. Writing off bad debts, okay? I'm not going to talk much about the direct method because it's not GAAP, it's not acceptable, but some small companies do it. Direct write-off, Teddy, means there's no allowance account at all. You just wait until somebody's not going to pay you, and then you write them off. That's the debit allowance for doubtful accounts, credit accounts receivable. The allowance method is the better method in what we're going to learn here. And you also have to understand it's required by GAAP. So you have allowance for doubtful accounts. We have accounts receivable with a debit balance, right? $500.
Yep.
We have allowance for doubtful accounts with a credit balance of $25. So the net receivables would be $475. And here's how it would look on the exam, on the, not the exam, on the balance sheet. Cash, accounts receivable. Now, this is different than they did it before this morning. Remember, Teddy? They put the allowance on the bottom of all the receivables. Remember that?
Yes, I do.
So here they're kind of contradicting themselves. But that's how you report the receivables. This is the right way to do it. Accounts receivable, less allowance for doubtful accounts. And then here they're just showing it net of the allowance, which is kind of clumsy. Credit sale of $100. We debit accounts receivable, we credit sales. Credit sales $100. Adjustment for bad debts. Now they're telling us the bad debt expense is $15. They're giving us the number, Teddy, Miguel. They're giving us the number. So what do we debit? We debit bad debt expense and we credit the allowance account. We credit the allowance account. And here's how it might be presented here. Accounts receivable, 227. That's the 250. That's the 250 over here. What happened to my 250? That's the 260 here minus the 25. So that's the write-off for bad debts. Notice that it's a credit to the allowance. Whenever you have a credit to the allowance account, the only possible debit is bad debt expense. So try to keep that in mind. You never do anything except debit bad debt expense if you're crediting the allowance. Okay?
Okay.
When we write somebody off, we debit the allowance. We debit the allowance. And the only thing you could possibly credit is accounts receivable. Okay? So those are the two journal entries for this chapter. Debit bad debt expense, credit the allowance. You do this one once a month. At the end of the month, it's an adjusting journal entry. Okay? When we know who the person is that's not going to pay us, then we write them off with the debit to the allowance and the credit to accounts receivable. Okay?
Okay.
And they're showing you that 227 again. So we write it off. We're going to write off Doran. What did we say the debit and credit was? Anybody want to try to answer that? We're going to use the allowance, right? We're going to debit the allowance. Oh, assume rights as uncollectible. Oh, for heaven's sake, Teddy, you see what it says on top? Direct write-off method. We're not teaching this. I walked into that. My bad. Features of the allowance method. The allowance method, we're going to estimate the uncollectible. We're going to debit bad debt expense and credit the allowance for doubtful accounts. Allowance for doubtful accounts is a contra account. It's a contra asset to accounts receivable. And the specific, when we write off the specific account, we're going to debit the allowance and credit AR. So this slide here, Teddy and Miguel, have this in front of you at all times, because these are the two entries we're going to have in this chapter. We really just have two entries and one reversal. Recording estimated uncollectibles. Hampson Furniture has credit sales of $1.2 million. of which 200,000 remain uncollected at December. Okay, so 200,000 is still in the receivables. 12,000 will prove uncollectible. If they just give you the number like that, that's the bad debt expense. If they give it to you, take it, $12,000. And there's the presentation on the balance sheet. Accounts receivable less the allowance for doubtful accounts equals $188,000. Good presentation. Now we're writing off somebody. Now we're writing off a company called RA Ware. They owe us $500, right? But they're not going to pay us, right, Teddy?
Yes.
So therefore, we have to take them off the accounts receivable with a credit and then use the allowance with the debit. Whenever you debit the allowance, the only thing you could possibly do is credit accounts receivable. There's no exception to that. And there they're showing you the journal entry. But look what happened. RA Ware has now paid us, even though we wrote them off. So this is what we did earlier this morning. It just means now, hey, we wrote them off, but they paid us anyway. That's great. Now we just have to reverse this entry to get them back on accounts receivable. Debit accounts receivable, credit the allowance, and now they're going to pay us. We're going to debit cash, credit accounts receivable. Okay.
Okay.
Okay, now we're going to use the percentage of receivables method. What we're going to come up with when we do this, and we did this before this morning, Teddy, when we do this, we're coming up with the balance that we want in the allowance account. Okay, it's not the bad debt expense. The amount of bad debt to be recorded is the difference between the required balance and what's there already. So think of it this way. The month ends and we have $10,000 as a credit balance in the allowance. The month ends and we come up with $30,000. Well, 30,000 is the new balance we want. So our journal entry is going to be for 20,000. The 10 that was there already minus the 30 that we need. And this looks like the same exact thing we did in class today. You have an aging. Notice as the days get longer, the debt becomes less likely to be collected, to the point where this company said, we're going to lose 40% of everything over 90 days. They really let these others get away from them, huh? So we came up with a total of 2,228. What did we do? We multiplied each column by 2%, 4%, added them horizontally. 2,228 is the balance we want. It is not the bad debt expense. So let's see what we have here. The unadjusted trial balance shows a balance of 528. We need 2,228. The difference is the 1,700. And that's the tricky part to understand, that when you're coming up with this number here, Teddy, and Miguel, when you're coming up with the 2,228, you're coming up with the new balance you want in the allowance account. And since they're saying the balance is already 528, we take 528 minus the 228 to come up with the right number. Here, they're just showing you, what if it's a debit balance? Well, then you'd have to add it. Just means that you had a debit balance you needed to offset. And there we go. Brule has been in business for 5 years. The unadjusted trial balance shows the following. Well, they got accounts receivable of 30, a little bit of allowance here. Bad debts are expected to be 10%. Prepare the entry to adjust allowance. 10% of 30,000 is 3,000. We've already got a $2,000 debit. So that's going in the wrong direction. That means we need a $5,000 adjustment. Think of it as, put it down as a T account. You had a debit balance of 5,000 and we wanted to end up with a balance of 3,000. How do we do it? With this entry here. Companies can sell their receivables to a third party. You can sell them to a bank, an investment house, a clearing house of some kind of speculator. And you do this because you want to get your money right away. You have $1 million in accounts receivable. Well, you're going to collect it, but you're not going to collect most of it for about 60 to 90 days. You want your money now. So you can go to a bank and say, how much will you give me now for my $1 million? And they might say, I'll give you 900,000 right now. And you might take it. That 10% difference is a fee that you're paying to the factor. It's called factoring. Factor. Assume Hendren Furniture factors 600,000 of receivables. They assess a service charge of 2%. So Hendren's going to get 588,000 after we take out the 12,000 in the factor fees. You understand what we're doing, Miguel and Teddy? We're selling our receivables in order to collect a big portion of them immediately. So we're giving away, in this case, we're giving away 2% of our receivables to somebody. What's going to happen now is we're going to get the 588,000 from the factor, and we are going to collect the remaining 600,000 and turn that over to the factor. Credit card sales. Credit card sales are kind of expensive to the retailer. They're talking here a charge of 2 to 4%. So when you go to the store and you buy something at Costco for $1,000, the store is not going to get 1,000. It's going to get 1,000 minus 2%. They're going to lose $20. You get $200. You go down to $980 or $900, whatever. Anita Ferrari purchases $1,000 of equipment using her Visa card. First Bank charges a Visa fee of 3%. That's not a charge to Karen. That's not a charge to Anita, who's buying the goods. That's a charge to the store. The store is going to have to pay 3% to Visa. So therefore, the store is not going to get 1,000. It's going to get 1,000 minus 3%. Gives them cash, okay? Credit card activity. Peter Kell needs to raise 120 in cash to cover the payroll. He's reached his debt ceiling. He can't borrow money, but he has a balance of receivables totaling 1,750. He decides to factor 125. So that means it's good. He's going to get a check right now for 125 minus what the factor charges, which in this case is 1%. So he's going to give away $1,250 to get $123,750 now. Okay. They're going to collect the rest of that money and turn it over to the factor. Let's talk have a little fun with notes receivable. Okay. Hey, Teddy, I have a question for you. This was the chapter we were working on today, right?
Yes.
Okay. Yeah, that's what I was a little confused. If we were a week ahead or a week behind. We're right on. Okay. Here we go. Explain how companies recognize, value, and dispose of notes receivable. Well, companies may grant credit in exchange for a promissory note. A note is an IOU. It's a written chit that says, I agree to pay you $1,000 back in a year plus interest at this interest rate. It's a very formal legal document. It's not like accounts payable, which is all based on faith, okay? So if you have a note and I have accounts receivable, you as a note holder would get paid before me in any liquidation proceedings, okay? So it's a bit of an advantage to own a note instead of accounts receivable. Plus the note is going to pay interest. So a company might have a customer, and here's an example of a note, by the way. We can take a peek at it, huh? Paid to Wilma. Wilma's borrowing $1,000 from the Calhoun Company, and it's for 2 months, and the interest rate is 12%. There's the date of the note. and the note becomes mature in 60 days, okay? 2-month note. And typically when you talk about the maturity date, you're talking when the money's due, basically. It's pretty simple, a stated date. And remember, note terms are expressed in months and days, but interest rates are expressed in years. That's why we always have to go through the loophole of taking percentages for a year and breaking them down into the appropriate days and months. And here we go, Teddy. This is what we were working on today. Face value with note, computing interest. Face value with note times the annual interest rate times the time in terms of 1 year. So what do we have here? We borrowed $730 at 12% for 120 days. They're assuming 360 days in a year for purposes of rounding. So 730 times 12% would, 730 times 12% would be the total for a year, but we only need 1/3 of it to cover the note. Here, it's a 6-month note. So that'd be 1,000 times 9%. That would be $90 times half a year, 45. And here's a 1-year note, 2,000 times 6%, 120, okay? You feel better calculating the interest now, Teddy?
Yes, I do.
Yeah, okay, good. Calhoun Company wrote a two-month promissory note dated the 1st to settle an open account. Now, here's what we're talking about. Wilma sold something to Calhoun, okay? And Calhoun has not paid. It's probably been a year now. Calhoun hasn't paid. So Wilma's talking to Calhoun. When are you going to pay me? Calhoun said, let's do this. Change my accounts receivable to a note. Make it a 2-month note, 12%, and I promise I'll pay you in 2 months plus the interest for 2 months. So the simple journal entry is we're going to debit notes receivable and credit accounts receivable. We have turned this accounts receivable into a notes receivable. And it's an advantage for both parties. It's an advantage for us because we're higher on the food chain now in case there was some kind of liquidation or bankruptcy. And it's good for Calhoun Company because they now have 2 months to pay us and gather up the needed cash. Valuing notes receivable. Report short-term note receivable at their net value. I think we kind of know that automatically. Disposing of notes receivables. Well, how do we get rid of them? Well, we get rid of them when they're paid. That's our favorite way of getting rid of them, right? They're paid, or the maker may default and the payee must make an adjustment. In other words, 60 days has gone by and Wilma has not paid us yet. That note has now matured and it's no longer any good. We have to turn them back into accounts receivable. Or the holder spends up conversion to cash by selling the note. You can always sell the notes in the open market. I borrow money from Miguel, right? And he's paying me 12% per month. I'm getting $1,000 a month from him. I could sell that note to you, Teddy, and you could start collecting the 12% if I wanted to do that. So the notes can be sold in the open market, just like a stock. Disposing of notes receivable. The note is either honored or it's dishonored. It's honored when it's paid. Honor, dishonor means paying, not paying. If it's dishonored, it means that the note holder, the note payer, did not pay at the maturity date. And so dishonored notes are no longer any good. They're no longer negotiable. You can't do anything with it except wad it up in a piece of paper and throw it away. A dishonored note is no longer negotiable. All you can do, if you're stuck with it, is put it back into accounts receivable. So here we go. We're going to honor a note. Wolder lends Higley $10,000, 5 months, 9%. And June, July, August, September, October. See, June, July, August, September, October. Yeah, 5 months. If Walter presents the note on the maturity date, the entry would be, we're going to debit the note payable for 10,000. We're going to have $450 worth of interest if I did the math right in my head, and we're going to get a cash payment. I did the math wrong in my head, 375, and we're going to get a cash payment of 10,375. Okay. How did we get that 375? $10,000 principal times the annual rate, monthly out, turned into a 5-month period. Okay. The accrual of interest receivable. So this is another important task we need to do. Suppose that Walter prepared financial statements as of the 30th. They're not getting paid until February or something, right? Yeah, they're not going to get paid for a while. But now they're running statements. So they have to say to themselves that we must come up with the interest for 4 months. For 4 months. We issued the note. We loaned this money out on June 1st. It's now the end of September. 4 months have gone by, 4 months of interest to accrue. And that was, I believe, 9% of 10 times 10,000. That's 9,000 a year, or 9,000 a year, or $75 a month. 4 times 75, $300. So we accrue it, and we debit interest receivable, we credit interest income, and then 2 months later when we get paid, we're going to end up debiting that payable, recording the rest of the interest, and collecting our cash. There we go. Debit interest receivable, credit interest revenue. Now now the note is being honored. Now we're going to get the cash. Well, we know we're going to get $10,375. We know we have a receivable of 300, and we know we have another month of interest revenue, 75. Debit cash, credit notes receivable, credit the interest receivable and the interest revenue for 1 month. Okay. 1 month. Now, Higley says they can't pay us. It's the maturity date. They're supposed to pay us. But they're too immature to pay us, okay? So we're going to have to turn that note back into a receivable. That's all you can do. Turn it back into a receivable. Plus the interest revenue. They still owe us that income, right? Even though they defaulted on the note, although they dishonored the note, they still owe us that interest. It's just that we can't charge them any interest after that date because it's back in accounts receivable. But we can still go after them for payment, and we will. We'll try to chase these guys down. What if on November 1st, there's no hope at all? There's no hope. The person who borrowed the money said, look, things didn't work out. I don't have a penny to my name. I'm going broke. The note holder would have to write off the face value of the note as follows: allowance for doubtful accounts, credit notes receivable. So what we learned there is we're going to use the allowance even to cover the write-off of a note. All right. Debit the allowance, credit receivable. Whenever you debit the allowance account, the only thing you could ever credit is a receivable. 99 out of 100 times accounts receivable. Here we go. Gambit accepts from Leonard a 3,490-day 6% note. Note matures on the 8th. What entry does Gambit make at the maturity date? Well, Gambit accepts from Leonard a note. So Gambit is going to debit their cash for $3,400 plus 6%. $3,400 times 6%, and it's a 90-day note, 90 over 360. So they're going to collect $3,451. They're going to credit interest income for the 51 and credit notes payable, okay? And now the statement presentation. And this is what we were looking at earlier. Here, you recognize this now, Teddy?
Yes,
This was your problem.
it was.
If we had found this slide, we'd get the problem absolutely correct. What
It was.
confused me though is typical. You don't start with receivables from unconsolidated. Typically you go trade receivables less the allowance. I've never seen the accounts and notes splashed together like that. But you get the idea. They list all the receivables, and then after they list all the receivables, then they show the allowance. I've not seen it done that way that much, to be honest with you. Typically, the allowance would be back up under the trade receivables.
Got
And
it.
you would never combine accounts and notes together.
Yeah.
That makes no sense at all. Well, now they just talk about how to manage your credit, you know. Want to establish a payment period, monitor collections, evaluate the liquidity. In other words, you want to sell to people who are going to pay you, right? But you don't want to be so strict that you give up business. In other words, Teddy, you have a business and I have a business. We both have a business, and last year we each had the same profit, okay?
Okay.
And then I made a decision that I am no longer going to sell except to top people. I'm only going to sell to people I know are going to pay me. And I did that. And I had a good year. My profit went from $1 million, say, to $1.2 million. Plus, I did not have 1 penny of bad debt expense. You, on the other hand, you made a different decision, Teddy. You decided that you were going to take some chances, that you're going to check out each person and make a judgment whether they're going to be able to pay you or not. You're going to take some risk. So what happened was you ended up with $100,000 worth of bad debt expense. I only had zero. But guess what? Your profit went from $1 million, not to $1.2 million, but your profit went from $1 million to $1.6 million. And why is that? Because you took some risks. And most of the people who you sold to did pay you. So my point is, you want to have a credit policy where you're not just selling to people who are 100% able to pay you. If you have no bad debt or no bad debt expense, you're not taking any well-intentioned risks. And that's what they're talking about here. If credit policy is too tight, customers will be lost, sales will be lost. If it's too loose, we're going to be selling to every bum in town and never get paid. So that's why you check the references, you check their financial statements, you get references, you look at their banking, their payment history, and then you can make a judgment. You know, a customer might come to us and say, I want to buy $1 million a month of your product. And then you look them over and they don't have very good financials. And they don't have that much money in the bank, frankly. So your first inclination was, we're not going to sell to these people. They can't pay us. But you get to know them a little bit and you see that the product they're selling is a great product. And you think long-term, they're a very good risk. Them you probably would sell to, and you'd get the benefits of that. You'd bear all the fruits. Payment periods, yeah, you got to pay in 30 days. Monitoring collections. Yeah, you want to be looking at your aging, you know, at least once a week or so. You want to keep looking at it. You keep your eye on those 30-day columns. You know, once a customer lapses into 30 days, maybe it's time for an email reminding them they owe you the money, or a text. If it goes to 60 days, it's time to call them up. A couple of metrics now. You ready? A couple of metrics. The AR turnover. The AR turnover. We're going to measure how quickly we collect our cash. Okay? How quickly we collect our cash. How do we do it? Here's the formula. We're going to take the credit sales, the net credit sales only, and divide it by the average inventory, average receivables. So let's take a peek at it. We had net sales of $34,350. They're giving us that. How do we get the average AR? We take the balance at the beginning of the year and the balance at the end of the year and average it out, dividing it by 2. So we have 9.9 terms here, 9.8 and 16, and Skechers is 10.6 in 16, okay? Talking in terms of turnover is confusing. So let's turn it into days. There are 365 days in a year. If you take a year and divide it by 9.9, you get 36.9. Let's call it 37. That is telling us that Nike collects its cash on average in 37 days. From the time they ship their shoes out, they get paid in 37 days. So that's Nike. And there's Nike the year before was about the same. Skechers does better though. Skechers collects faster. Why do you sell the receivables? Why do we sell to the factors? Maybe the size might be the only reasonable source of cash, and billing and collection are time consuming. Some companies say we don't even want to try to collect our cash, our accounts receivable. We don't want to do that. We're just going to keep selling it to a factor for 1%. Managing receivables, decide who you're going to sell to. You know, you don't want to sell to bums, but you need to take a risk. Make sure people know that you expect to get paid in 30 days. Be clear on that. People not paying you, you call them right away. Then you look at your receivables every month and you decide how much of that is bad debt expense. LeBron James Company. LeBron, the name is familiar, Teddy. I just can't place the name. LeBron James.
Yeah.
LeBron James Company had credit sales of 923,795. And then they're giving you the beginning and ending balance of accounts receivable. Well, we know we're going to take those credit sales, that becomes our numerator, and we're going to divide it by the average, divided by the average accounts receivable. So here are your days to collect. Let me see, how many days was that? Oh, I didn't finish. Average days to collect. 14 days to collect. That is super fast, huh? People don't want to mess with LeBron James.
Yeah, I don't blame him.
And now we get into the internationals, at which point we stop. Okay. So this chapter is a little bit tricky when it comes to the bad debt expense, guys. Otherwise, it's fairly straightforward. Okay.
Okay.
Any questions, Teddy?
No, I guess the slides just helped go into more detail, so that was
Okay,
helpful.
Yeah, you and Brenda got a good head start with the homework, it looks like.
Yeah.
That'll be
Actually, right after when we met this morning, I started the homework and almost completed it, so I'll probably finish it now.
That's excellent. Excellent. Keep it up.
Thank you. I will.
How you doing, Miguel? Any questions?
Well, no. I was thinking. I was trying to do a same example like the model you show us.
Okay.
Yes, because I think. Oh, 1 second, please. Okay, sorry. Yes, I was making a model for take for 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 make the same example as you made.
Okay.
I would like to see again the presentation in the video you will post then in YouTube. So
On the bad debt, you're talking about the bad debt expense, right?
Mm-hmm.
Yeah, I can show you that. Here we go. We're getting there. Okay. Is this what you want to see when we start with the bad debt expense, Miguel?
Yes, that one. Yeah.
Okay. Think of it this way. We sold something for $500, okay? We sold, make that a big number so it makes sense. That's $500,000 we sold. And it's sitting uncollected in accounts receivable. Of that 500, we think 25 is not going to be collected. And that's kept in this account called allowance for doubtful accounts. So you have 500 in accounts receivable, less the allowance for doubtful accounts gives you 475 net receivables. And then they present it on the balance sheet. Now, I think what you're asking now is what happens when it's time to do the bad debt expense, right?
Yes.
Okay. So they're just showing us collections here. Okay. When we record bad debt, I'm going to skip this because I don't like that presentation. Okay. Get to a better set. Okay. We have two things. We have a write-off. I'm going to, forgive me, I'm going back. When we estimate the bad debt, and that's what we're doing, Miguel, at the end of the month, it is an estimate. We are going to debit bad debt expense and credit the allowance account. Okay.
Okay.
This is one of, there are two line entries in this chapter that we need to know real well. One is this one. End of the month, debit bad debt expense, credit the allowance. Okay. Then we have the second 2-line entry when we write somebody off. By what we mean by writing off is removing them from the accounts receivable. So now we have a bum who's not going to pay us. It's time to get rid of this person. We're going to use the allowance that was set up for that purpose. We're going to debit the allowance for 10 and we're going to credit accounts receivable. So those are the two basic journal entries. Here they're saying we're writing off somebody. Bad debt expense, that's the direct method. I fell into that a second time. Okay. Hampson Furniture has credit sales of $1.2 million. 200 remains uncollected. They're estimating that 12,000 will be uncollectible. They're giving you the number. So there's that journal entry again. Debit bad debt expense, credit the allowance. Here is a write-off. Here we know that R.A. Ware is not going to pay us. We're going to use the allowance. We're going to debit the allowance and credit the asset account, accounts receivable. The allowance for doubtful accounts is a contra asset account. It's married to accounts receivable. The two go together.
Okay.
And then we're getting paid back on a recovery. Now here, do you want to look at this one too now, Miguel?
Sorry?
This is what you wanted to see, right?
Yes, that one. That's
Okay.
right.
Okay. So now we're talking when we're working with the receivables. When they are working with the aging of receivables, Miguel, it's not difficult to come up with the number. What's important, though, is to understand what the number represents, okay? So if you look at these columns, if it's not yet due, well, we think we're only going to lose 2%. But if it gets out 30 days old, we're going to lose 4%, 10, 20. And if it's over 90 days, wow, we're going to lose 40% of it. We don't know who, though. We're just projecting the future. So we're going to take all these multiplications and add them across to get the 2228, all right? Now, the 2228 is not, and I repeat, is not the bad debt expense. It is the balance that we want in the allowance account at the end of the month, okay? So let's try to understand that. The unadjusted trial balance has the allowance already with a credit balance of 528. So we're going to take the 528 and subtract it from the 2228, and that's where we get that. That help a little bit, Miguel?
Yes, yes. Now I understand this part.
Okay.
Yeah.
Yeah. The tricky part is understanding that this is not the bad debt expense.
Mhm.
It's the balance we want. And since we already have 528, we only need 1,700. And then in the next example, they change it to a debit balance. So that just means you have to add them together, okay?
Okay.
And they're just showing you the journal entries again. Debit, bad debt expense, credit, the allowance. So that help you, Miguel?
Yes, it helped me a lot. Thank you very much.
Okay, well, you guys have a good afternoon, okay?
Thank you, Bob. I appreciate it. You have
Have
a
a
good one
seat.
yourself.
Take care, Miguel.
You take care.